Central banks bought more gold in 2023 than any year since 1950. The headlines call it fear, war hedging, inflation protection. The headlines are wrong. This is not about fear. This is about collateral. The world's reserve asset is changing. And when the reserve asset changes, everything built on top of it breaks. For 50 years, the global financial system ran on a simple foundation. U.S. Treasury bonds were the risk-free asset, the collateral that backed everything. That foundation is cracking, not because treasuries are defaulting, but because the world no longer trusts them as neutral, safe, or sustainable. This is the story of the great collateral shift, the invisible mechanism by which central banks are quietly dismantling the post-1971 monetary order, not through announcements or summits, through purchases, one gold bar at a time. In this investigation, we are going to show you why U.S. Treasuries lost their risk-free status, how central banks are repositioning gold from a commodity to Tier 1 reserve collateral, and what happens when the Federal Reserve becomes the only buyer left for U.S. government debt. This is not the dollar's death. This is the end of the dollar's monopoly. And the transition is the crisis, educational analysis only, not financial advice. To understand what is breaking, you need to understand what used to work. The current global monetary system was not designed. It evolved from an accident. In 1971, Richard Nixon closed the gold window. The dollar was no longer convertible to gold. This ended the Bretton Woods system, but it did not end the dollar's dominance. It transformed it. Here's how the new system worked. A country exports goods to the United States, cars from Japan, electronics from Taiwan, oil from Saudi Arabia. They receive dollars as payment. But what do you do with dollars? You cannot eat them. You cannot build factories with them. You need to convert them into an asset. The best asset was U.S. Treasury bonds. Why? Because Treasuries had three critical properties. Property one, liquidity. You could sell $1 billion of Treasuries in minutes. No other bond market in the world had that depth. If you needed cash fast, Treasuries were the only option. Property two, safety. The U.S. had never defaulted. The government had taxing power over the world's largest economy. The bonds were backed by the full faith and credit of the United States. This was considered ironclad. Property three, neutrality. The dollar was not a weapon. It was a medium of exchange. The U.S. did not freeze accounts or seize reserves based on political disagreements. Holding dollars was safe from geopolitical risk, or so the world believed. This created a self-reinforcing cycle. Countries exported to the U.S. They received dollars. They bought treasuries. The U.S. could borrow cheaply because there was always demand for its debt. This demand allowed the U.S. to run persistent budget deficits without consequences. The world funded American consumption and military power. In return, the world got liquidity and safety. This was the bargain. And for 50 years, it held. But the bargain is breaking. Not because one side cheated, but because the math and the incentives have changed. Let me show you the two shocks that destroyed the foundation. Shock one, the fiscal math became unsustainable. The United States national debt is now $37 trillion. The interest on that debt is approximately $1.5 trillion per year. That is more than the defense budget, more than Medicare. It is the second largest line item in the federal budget after Social Security. And it is accelerating. Here's the problem. The debt to GDP ratio is 130%. During World War II, the U.S. hit similar levels, but that was temporary. The war ended. Spending fell, and the economy grew, the ratio declined. Today, there's no plan for the ratio to decline. The Congressional Budget Office projects deficits of $1 to $2 trillion per year indefinitely. The debt will grow faster than the economy, forever. Now apply basic bond math. If a country has unsustainable debt, its bonds carry risk, currency risk. The government might inflate the debt away, default risk. The government might restructure or impose capital controls, political risk. The government might change the rules. U.S. Treasuries are no longer risk-free, they are risk assets. And when a risk-free asset becomes a risk asset, the entire financial system built on that foundation is undermined. Shock 2. The dollar became a weapon. In 2022, the United States and its allies froze $300 billion of Russian central bank reserves. This was unprecedented. Central bank reserves were supposed to be sacrosanct. They were the neutral assets that countries held to stabilize their currencies and manage crises. Freezing them turned the dollar from a neutral medium of exchange into a geopolitical tool. The message to every other country was clear. If you displease the United States, your reserves can be frozen. Your access to the dollar system can be cut off. Your economy can be crippled overnight. This created an incentive problem. If you're China, India, Brazil, or any country that might have future conflicts with the U.S., holding dollars is now a strategic liability. You need to diversify. Not because you hate the dollar, but because you cannot afford to be vulnerable. These two shocks Fiscal unsustainability and weaponization broke the three properties that made Treasuries the global reserve asset. Liquidity is still there, but safety and neutrality are gone. And without safety and neutrality, Treasuries are just another bond, a large liquid bond, but not a reserve asset. Now let me show you what central banks are doing in response. They are not just selling Treasuries and holding cash. They are buying gold. But this is not the gold trade you see on cable news. This is not retail investors buying coins. This is central banks buying thousands of tons and fundamentally changing how they use it. Here's the mechanism. Historically, central banks held gold as a legacy asset, a relic from the gold standard. It sat in vaults. It was not used for anything. It was just there, a symbol. When central banks needed liquidity, they sold gold and bought treasuries. That was the trend for decades. Gold reserves declined. Treasury reserves increased. That trend reversed in 2010, and it accelerated after 2022. Central banks are now net buyers of gold. In 2023, they bought over 1,000 tons. China, Russia, India, Turkey, Poland, Singapore. The buying is global. But here's the critical detail that most analysis misses. They are not just storing this gold in vaults. They are using it as collateral in a new type of monetary arrangement. Let me explain with an example. Russia sells oil to China. In the old system, Russia would receive dollars. Russia would then use those dollars to buy goods from other countries or buy U.S. treasuries. The dollar was the intermediary in every transaction. But Russia's dollar reserves were frozen. They cannot use that system anymore. In the new system, Russia sells oil to China and receives yuan. But Russia does not want to hold large amounts of yuan long term. Why? Because the yuan is not fully convertible. It is not a global reserve currency. There is political risk. So what does Russia do? It negotiates a swap arrangement. China holds gold as collateral. If Russia wants to convert the yuan back to a hard asset, the gold backing is there. The trade settles in yuan, but the ultimate settlement layer is gold, not dollars. This is not a one-off deal. Variations of this structure are being negotiated across the BRICS economies and the global south. The common thread is gold as the tier 1 collateral, not treasuries, not dollars, gold. Why gold? Because gold has one property that no other asset has: zero counterparty risk. A U.S. Treasury bond is a claim on the U.S. government. If the U.S. freezes your account, the bond is worthless to you. A bar of gold in your vault is not a claim on anyone. It is a physical asset. It cannot be frozen, hacked, or inflated away by a central bank. In a world where trust in institutions is declining, zero counterparty risk is the most valuable property an asset can have. This is the invisible mechanism. Gold is transitioning from a commodity to a monetary asset, not because governments declared it money, but because central banks are using it as the collateral layer in an emerging parallel monetary system. Let me walk you through the cascade that is now unfolding. This is not a single event. This is a multi-stage collapse of demand for U.S. treasuries and the emergence of a parallel reserve system. Stage 1. Foreign treasury demand declines. Foreign central banks are the marginal buyers of U.S. treasuries. When the U.S. runs a budget deficit, it issues bonds. Someone has to buy them. Historically, foreign central banks bought 30% to 40% of new issuance, but that share is falling. In the last 2 years, foreign holdings of treasuries have been flat or declining. China has reduced its holdings. Japan has reduced its holdings. This is not a crisis yet, but it is a trend. When foreign demand declines, yields must rise to attract other buyers. Higher yields mean higher interest costs for the U.S. government. The deficit gets worse. More bonds must be issued. But if foreign buyers are stepping back, who buys the new bonds? Stage 2. The Fed becomes buyer of last resort. In the short term, domestic buyers can absorb some of the slack. Banks, pension funds, mutual funds. But they have limits. Banks face capital requirements. If they hold too many treasuries and yields rise, they take mark-to-market losses. We saw this in the regional banking crisis of 2023. Pension funds have liability matching constraints. They cannot buy unlimited quantities of long-duration bonds. When private buyers are tapped out and foreign buyers are stepping back, there is only one buyer left: the Federal Reserve. The Fed can print money and buy treasuries. This is called yield curve control or quantitative easing. The Fed used it in 2020. They will use it again. But here is the trap. When the Fed prints money to buy treasuries, it expands the money supply. This is inflationary. Inflation erodes the value of the dollar. Foreign holders of treasuries see this. They see that the U.S. is inflating away its debt. This confirms their fears. It accelerates their shift to gold, more foreign selling, more Fed buying, more inflation. The doom loop accelerates. Stage 3, the parallel system becomes operational. While the treasury market is grinding through this doom loop, the parallel gold-backed system is maturing. It started with bilateral arrangements: Russia-China, China-Saudi Arabia, India-UAE. But these arrangements are standardizing. The BRICS countries are discussing a common settlement mechanism. It would not be a single currency. That is too difficult politically. But it would be a clearing system where trade imbalances are settled in gold or gold-backed instruments. If this system becomes operational, a significant portion of global trade could bypass the dollar entirely. Not all trade. The dollar will still be used, but it will no longer be the only option. And when you lose monopoly status, you lose pricing power. The U.S. will no longer be able to run unlimited deficits funded by foreign demand. The exorbitant privilege ends. But here is what makes this cascade unstoppable. It is driven by incentives, not ideology. Even countries that are allied with the U.S. have an incentive to diversify. Why? Because holding all your reserves in one asset controlled by one country is a concentration risk. It is bad risk management. Central banks are not trying to destroy the dollar. They are trying to survive the next crisis. And survival means diversification. The U.S. cannot stop this by raising interest rates. Higher rates make the debt unsustainable. The U.S. cannot stop this by threatening sanctions. Threats accelerate the desire to diversify. The U.S. cannot stop this by going back to a gold standard. The U.S. does not have enough gold. Fort Knox holds about 8,000 tons. That would back maybe 10% of the monetary base. The math does not work. This is a systemic shift with no policy lever to reverse it. The only question is how fast it unfolds. Let me translate the macro collapse into personal impact. Because when the reserve asset changes, the effects ripple through every financial decision you make. Your savings lose purchasing power faster. If the Fed is forced to print money to buy treasuries, inflation stays elevated. The official CPI might say 3% or 4%, but your real cost of living is rising faster. Groceries, rent, insurance, energy. The things you actually buy are inflating at 6% to 8%. Your savings account earning 4% interest is losing purchasing power every year. You're being taxed silently. Your bond portfolio becomes a risk asset. For decades, the 60-40 portfolio was considered safe. 60% stocks, 40% bonds. The bonds were supposed to be the stable part. But if Treasury yields spike because foreign demand is collapsing, bond prices fall. In 2022, long-term Treasuries lost 20% to 30% of their value. If the great collateral shift accelerates, that could happen again. Bonds are no longer the safe haven. They are the risk. Your currency exposure becomes critical. If you hold all your wealth in dollar-denominated assets, you're making a concentrated bet on U.S. fiscal sustainability. That might be fine, but it is a bet. If the dollar weakens structurally because reserve demand is shifting to gold, your wealth declines in real terms. Diversification used to mean stocks and bonds. Now it means currencies and hard assets. Your access to cheap credit ends. If the U.S. has to pay higher interest rates to attract bond buyers, those higher rates flow through the economy. Mortgages become more expensive. Auto loans become more expensive. Corporate borrowing becomes more expensive. Economic growth slows. Unemployment rises. The wealth effect reverses. Even if you have a stable job, the opportunities for advancement shrink because companies are not investing. Your retirement plan assumptions break. Pension funds and 401k models assume 7% annual returns. Those assumptions are based on a world where treasuries yield 2% to 3% and stocks can compound safely on top of that base. If treasuries yield 5% to 6% because of risk premiums and stocks face margin compression from higher rates, returns fall. A 4% or 5% real return becomes the new normal. Retirement savings need to be 50% larger to generate the same income. Most people have not adjusted for this. This is not a collapse. It is a repricing. A repricing of risk, of return, of what assets are safe, and repricings are painful for those who are late to adjust. We have mapped the mechanism, the fiscal unsustainability of U.S. debt, the weaponization of the dollar, the central bank shift from treasuries to gold, the doom loop that forces the Fed to print, the emergence of a parallel gold-backed settlement system. Each piece is documented, each piece is mechanical, and the pieces are connecting. So, how do you know when this shift is accelerating from a slow trend to a fast crisis? There are 3 signals to watch. Signal 1, foreign treasury holdings. Declined for 3 consecutive quarters. The Treasury Department publishes data on foreign holdings monthly. If you see 3 consecutive quarters of decline, that is not noise, that is capital flight. It means central banks have made a strategic decision to reduce exposure. This has not happened yet on a sustained basis. But if it does, it is the red flag. The buyer base is shrinking. Signal 2, the Fed announces yield curve control or a new QE program. If Treasury yields spike to 5% or 6% on the 10-year, and the Fed steps in with an emergency program to cap yields, that is the admission. The admission that the market cannot absorb the debt without central bank intervention. The Fed will not call it yield curve control. They will call it market functioning or liquidity support. Ignore the language. Watch the balance sheet. If the Fed is buying hundreds of billions in Treasuries per month, they are the buyer of last resort. And that is the doom loop going live. Signal 3. A major trade deal settles in gold-backed currency. If China and Saudi Arabia announce that oil purchases will be settled in yuan with gold collateral, or if BRICS announces a gold-backed clearing mechanism for intra-block trade, that is the parallel system going operational. It does not mean the dollar is dead, but it means the monopoly is broken. And once broken, it does not come back. Watch for these 3. If you see one, pay attention. If you see 2, reposition. If you see all 3, the great collateral shift is no longer invisible. It is the new reality. This has been the story of how the world's reserve asset is changing. Not through war or revolution, through the slow mechanical logic of incentives and risk management. U.S. Treasuries were the foundation of the global financial system for 50 years. But foundations crack when the weight becomes too great and the trust erodes. Central banks are not attacking the dollar. They are protecting themselves. They are diversifying from a concentrated, weaponized, fiscally unsustainable asset into an asset with zero counterparty risk. Gold. Not because gold pays interest, not because gold is growing, but because gold cannot be frozen, hacked, or inflated away. This is not the dollar's death. Currencies do not die. They lose monopolies. For 50 years, there was one reserve asset. Now there will be 2, the dollar and gold. Some trade will settle in dollars. Some will settle in gold-backed currencies. The transition from 1 to 2 is the crisis. The repricing of risk, the collapse of assumptions, the breaking of the old rules. And the crisis is already underway. It is slow, it is quiet, it is invisible to those not watching the central bank balance sheets. But it is mechanical. And mechanical processes do not stop because they are inconvenient. They stop when the incentives change. And the incentives are not changing. They are intensifying. The great collateral shift is not a prediction. It is a process. And the process is accelerating. Stay informed. Watch the signals. And remember, when the reserve asset changes, everything built on the old asset must be rebuilt. The question is whether you rebuild before the transition or after. Before is preparation. After is crisis management.